Most beginners fail not because their strategy is bad, no, because they don't understand the language of the market. So in this session or in this episode, we are going to explain the terminologies you have to understand before thinking about placing any trade. The topic for today's session is market mechanisms and terminologies. So understanding how the market works, that's what we are going to get in this video. The core trading terminologies, as we said, and practical calculation basics. We'll get to it. So the next we are going to talk about is what are pips. So pip, which is what percentage in profit, is the first word. The smallest price movement in most currency pairs is usually in two decimal places, which can be 0.01 pip, right? So this is what we mean by pips, percentage in profit. Someone will say why pips matter. Okay, so pips matter because we use it to measure profits and loss. When you want to measure your profit or your loss, you have to know the pips you are using. So you hear traders saying, I'm using 10 pips, I'm in profit 10 pips, 50 pips in profit, 100 pips in profit, and say, oh, we hit SL, we hit 20 pips SL. So we use pips to calculate what measure profit and loss, right? And it's also what it matters because it helps us to calculate risk. If I want to calculate the risks, I'll be risking on a specific trade. I should know the pip. Don't worry, as we move forward, we'll understand how to calculate pips. But we first have to understand what pips are before we move into the calculations. So it helps calculate rates. If I know the pips I'm risking, if I have 30 pips Excel and 100 pips TP, I know my rate. It helps me calculate my rates. And so what is the standard unit for comparing trades. So I'm going to move to the next, which is what is a lot. Lot is what position size in trading. I'm using 3 lots, I'm using 0.01 lot, I'm using 0.03 lot, I'm using 0.05. Any lot is what it is position the size in trading. And we speak about why lots is necessary. We spoke about pips. We are now speaking about lots. And the standard lot is what 100,000 units. When I say mini lot, I mean 10,000 units. When I say micro lot, 1,000 units. I'm going to speak about why lot size is important. It tells me what determine how much you gain or lose per pip. So for me to I know that I use the pip to calculate how much I'm risking. So the lot will help me determine. I'm using zero point 0.0 lot size on 30 pips. It helps me determine how much what I'll gain or I'll lose per pip. So when an individual is using bigger lots like 100 lot size, 20 lot size, it's what it means the bigger risk. And when a person is using what smaller lots, it's what controlled risk. So we now know the difference between pips and we know the difference between what lot size. So pips are also what pips help us to know what you are risking and what you are gaining, and the lot size help us to determine how much you gain or lose per pip movement. Right. Going to move after the spread. We spoke about pip, lot, and spread. So these we are speaking about the terminologies of the market. So when I say spread, spread is the difference between bid and the ask price. Someone will say, what is spread? So spread is what the cost to pay, the cost paid to a broker. So last time we spoke about brokers, you have to watch the previous video, how to choose a regulated broker and why you have to choose a regulated broker and how to find whether your broker you are using is what is regulated. So don't forget to go to the previous video and learn from it and come back and continue with this video. So when I say spread, spread is what the cost or it's a fee brokers charge to be able to place your trade depending on the broker you are using. That's why I have to go and look for the reviews, check the regulations of a broker, check the spread. If the spread suits you, then you go. So understanding spread. So when I say when you move to a currency, when you open your MT5, we speak about trading tools. We spoke about trading view. We'll move to MT4 and MT5 in our next video. So don't forget to what turn on notifications so that if we drop the next video, you'll be the first to reach out to it. So when I say US Euro USD bid price, when you open your MT5 or MT4, you go to the quote side, you go to those areas, you see the bid and the ask price. So it's usually numbers that are changing. Let me go to it and let me just show it to you. We'll speak about MT4 and MT5. So just turn on your notification, stay with us. Okay, so when you look here, I don't know whether you can see. if you can see the bid and ask price, as you said, what they vary. And you see bid and ask price, BTC and gold, they are all having was their bid and ask price. So to calculate the spread, which you spoke about, spread being what the fee brokers charge. So you have to look for a regulated broker. Is it HFM? Is it XM? Is it Xness? Check their spread. If they have tight spread, then go with it, because when the spread is small, when the fee is small, right, it makes trading very friendly. You are not risking huge, right? So we said what Euro USD bid. If the bid price is 1.100, let me check Euro USD here. Euro USD. Okay, I've added Euro USD. Okay, when I go to Euro USD, here you can see, when I go to Euro USD, as Euro USD, the bid price is 1.14242, and the ask price is 1.4262. Right. So the difference between the ask, which is the 264 and 243, so around 20 pips. Yes, around 20 pips, that's the spread. So you have to check a broker. You check the currency pair you are trading, and you check the broker which allows what a smaller spread for the pair you want to trade, then go with it. Right. So you don't just choose brokers, you have to be checking all these. You have to understand the spread. What spread is? Spread is the fee they charge. So now let's move to the next slide, which is bid and ask price. So now let's explain bid and ask price. Someone said, Obed, you told me about spread. You said spread is the fee. So how do I calculate for spread so that if I'm using the broker, I check that their spread, their fee is very small, and I go with that broker, right? So when you check, as I was explaining here, the bid price, the bid is what the price you sell at, and the ask is the price you buy at. So the markets always show both prices. So with this, you were seeing both prices, the bid and what the ask price. But the market also always shows. So when I say the bid price, the price you ask, the price you sell at, the price you sell at, and the ask is what the price you buy at. So this is the simple explanation of what a bid is and what an ask is, right? So now let's move to the next thing, which is buy and sell. What is buying and selling? Some of them, when you go to the forex market, we are buying, others are buying, others are selling. Oh, but I want to understand why we buy and sell in the financial market. Okay, so when you say buy, most of the time people say long. I'm longing the market. When you say I'm longing the market, that means what he's buying. The person is buying. So if you expect price to rise, price to move up, you are buying it, right? And if when you say sell, so I'm shorting Euro USD, I'm shorting gold. That means what you are anticipating price what to fall. So the profits you make, it depends on what the direction of the market. So if the market is moving in an uptrend, or we call it uptrend, or it's longing, or the price is moving up, that means what you are making profit, right? So when the price is moving up, then you are buying, you are making profit. So profit depends on the direction of price movement, right? I've explained buy and sell. Someone say I'll be buying, I'll be selling. What does that mean? So when someone buys and price moves up, the person will be making profit. And when the person sells, then price what moves down, the person was making profit. Now you've understood the principles between buying and selling. So what is leverage? You've understood what pip, lot, spread. Now we are moving. So leverage allows control of large position with small capital. So you see most traders saying use 1:2000 leverage, use 1:200, use 1:100 leverage. So leverage allows you to control. It gives the control of large position with what small capital. So you have to check the broker leverage, the leverage the broker allows you. So these are all the criteria and market terminologies you should know before choosing a broker or deposit, or thinking about placing a trade. So it is expressed as ratio form. As I said, 1:100, 1:2000. Others give 1:unlimited, but I've not seen 1:unlimited. Okay, so it magnifies profit and loss. So leverage magnifies profit and loss. Let me give you an example of leverage. So when I say the broker gives you, or you chose 1:100 leverage, that means per $100 position, it controls 10,000 positions. So now you understand why leverage magnifies your profits or your loss. So per $100, When you put $100 down, it controls 10,000 positions. When you put $50 down, it controls what? 5,000 positions. You just multiply by what? By the 100. So if you have a higher leverage, you have what? A higher risk. So what is margin? Come on, ask, what is margin? We spoke about spread. We spoke about pip. We spoke about lot. Someone says buying and selling. How does the person make profit? And now we are moving to what is margin. We spoke about leverage already. So margin equals money set aside to open a trade. Margin is the money set aside to open a trade. It's not a fee, but it's like a collateral. Why margin? The required margin, it depends on your leverage. So if you have a higher leverage, your margin will also be will be higher. Now let's as we understand margin. Now what is margin call? So these are all market terminologies you should know before thinking about placing a trade, depositing. You should know all these terminologies of the market. So what is margin call? So it occurs when an account equity. When I say an account equity, equity is the total money you have in your broker. So when an account equity falls too low, so when your account, let's say you have a $10 account and your balance, you are in a trade where you are going in a drawdown of minus $9. You see, $9, almost the $10 for your account to blow. When you say blow, that means you lose your account. That's what we mean by you've blown your account. You've lost your account. So equity falls too low. So the broker will warns or closes positions. So when you have a margin call, it's either your broker will close position for you to left with some couple of banks dollars in your account, or they will just warn you, send you a notification that margin call. That's how margin call is. So what does margin call does? What's the importance? So it protects your account from going to negative. So you don't want the situation where you've deposited $10, you took a trade and now you hit yourself minus 20. Your account is now minus 10. That means when you deposit, automatically what you are deducted. So this is what margin call does. What it protects your account from going into what negative. Now going to move to risk versus reward basics. Someone will say most of the time we use the word risk to reward. So risk is what? The amount you are willing to lose. Simply explain, risk is the amount you are willing to lose. So before you take any trade, you should consider your risk and reward. Before you take any trade, you should know that I'm willing to risk $20 per this trade. I'm willing to lose or risk $100 for this trade. When I say the money you are risking to lose, you are willing to lose is the risk. And when you talk about reward, reward is your expected profit. It's your expected profit. So this brings about the risk to reward ratio. So when I say my risk to reward is 1:2, like if I have a $50 account, then I say I'm risking $10 in a trade and my risk to reward is 1:2. That means I'm willing to lose $10 and expecting a profit of $20. So that's what risk to reward. So the same way I'm risking $10 and my risk to reward is what 1:5. That means I'm willing to lose $10 for what? For $50. Simply explain risk to reward. Simply explain. Okay, now let's move to why risk management matters. So when you consider risk to reward, that means you are considering risk management. And why does it matter? It matters a lot because what it protects your trading capital. Because if you have your risk to reward per every trade, I'm having a $50 account. Per every trade, I'm willing to what? To lose $10, right? To lose $10, right? That means if I take a trade, my risk to reward is 1:5. That means if I take one trade, then I hit 40 1:5, I have what? $50 profit. I've doubled my account from what? $50 to $100. That means if you take 2 losses or 3 losses in a row, your account is what? Not affected because your risk to reward is what? 1:5. So it ensures long-term survival. If you understand risk management, if you consider risk to reward, it ensures what? Long-term survival. And professional traders focus first on that. If you're a professional trader, risk to reward is something you move with. So calculating pips simply, we said if Euro USD move what 1.1000 to 1.1050, the difference is what 50. Then that makes the pips. So it's simple. This is simply how to calculate pips, and always subtract the what entry from the exit. So we are simply calculating. This is different, way different from the pips we spoke about. Right, this is different from the spread we were speaking about. So for this, if you are calculating your pips, so you are in a trade and the price of you entered the trade when Euro USD was 1.100 and now it's moved to 1.050. So the difference is what, 50 pips. So this is how to simply calculate for pips. And let's move to the next thing I want us to speak about: understanding position sizing. When I say position sizing, I mean what? Choosing correct lot size, because you have to protect your capital. So you have to choose what, the right lot size. So it is based on your account size, based on the risk percentage per trade. So most traders, some people say I'm risking 1% per every single trade, 2%, 5% per every single trade. So it's what, it is your responsibility to what, to choose the correct lot size, right? So position size example. Let me give an example. So if I now have an account, then it's $1,000 account. So if I'm risking 2%, that means I'm what? I'm risking $20 per trade. So lot size is choosing based on what, your stop loss distance. So if you want to choose your lot size, maybe 0. We spoke about lot. You don't check your profit to calculate your lot size. No, you check the risks, or the risks, how much you are willing to lose. If you are willing to lose $20, then you calculate based on what. So you choose your lot size based on what, your stop loss distance and the pips you are risking. And now let's move to the next, which is on the summary. What you've learned so far. We learned what, pips measure the movement, lot control, risk exposure, leverage, and margin require what, caution. Spoke about margin call, and you have to always focus on what, risk versus your reward. Big congratulations to those who stayed from the starting of the video to the end of the video, because you learned how to, you learned what pips, lots, and spreads are. You learned when to buy and sell. You learned basic simple risk to reward concept, and you also learned how margin and leverage works. Forex is not gambling, it's a skill, and every professional trader should understand the mechanisms of the market before focusing on strategy. If you enjoyed this video and this video helped you change the way you look at the market, your understanding, and was very educative, and you found this video very interesting, don't forget to what, turn on your notification and click on the subscribe button, comment, like, and share to others who would also what, benefit from this video.